and welcome everyone to today's webinar. So as Sonia noted before, today I'm going to be speaking about how you pass a real estate financial modeling test. A very common test now, and especially being used more year on year, where essentially recruiters and companies are looking to see, when you go into that company, what skills do you have? How much do they need to train you up? And kind of what will they have to do in the long term to see how to develop you and fit within that team. Remember, every real estate company has kind of their own goals that they are wanting to do. Some might be private equity, looking at big development projects that are very risky. Some may be just buying core properties and have very different stable cash flows. Depending on the company that you go into will require different skills and different knowledge. And especially with real estate, we know there's a wide variety of asset classes in real estate. We've got commercial and residential. We've got within commercial, we've got hotels and offices and industrial. Each one has a slightly different treatment, slightly different lease events going on and different revenue streams. And you have to treat each one differently. So depending on the company that you apply to, you have to think about, when I apply to that role and I'm going to be given this real estate financial modeling test, if I'm applying for someone that invests mainly in hotels, well, I need to be thinking about what type of cash flows do hotels have, what type of expenses and operating expenses they have, staff and management and tax, what have you. So you need to think about that just as I go through today's webinar, because it'll have a big impact on what type of test you may end up seeing at the end of it. So without further ado, let's have a look at some of the tips and tricks. And today I'm going to show you some tips and tricks, some do's and do nots, and what kind of you should be expecting from these real estate financial modeling tests. I have to be somewhat general here because every company does them slightly differently. And I've actually done some myself. I've done one for Morgan Stanley and a couple of other different companies when I was going to go into real estate. However, I decided to go into academia in the end. And what I noticed when I did them is that there's a variety of different ways that they can be presented, and they're trying to test you according to that company's kind of ethos and what type of cash flow models they use. So in terms of the knowledge that you need before you walk into that test, one of the first things and the critical things is knowing the basic Excel functions. So this might be knowing the if function or the or function. If we look at, say, return metrics, we could say, well, do you know how to do an IRR or an XIRR, an NPV or an XNPV? Remember, depending on which function you use, you'll get a different result. And you need to make sure that you know the basics of how you implement them functions and also interpret them correctly. When you use an if function, where do brackets go? How do they say we're looking at the tenancy start date? So we might use a nested if it's a very complex cash flow. Well, how do they work? So starting to practice your Excel, learning what does that function do? How do I apply it? Will really give you a good, strong start. So knowing the basics of Excel is one bit, but also you need to know about three different other areas in particular. One is lease modeling. And when we talk about leases, generally speaking, what I'm thinking about is what's the tenancy start date? What is going to be happening across that tenancy? How often do we have, say, rent reviews? If we're looking at, say, we're modeling vacancy, well, what's our expected vacancy period? Do we follow a model in that? So we often talk about maybe the natural vacancy rate. Some companies use that. Some say it's a bad model. So depending on how you propose that, you need to make clear for, say, what vacancy rates we're using. You might want to also, when we're doing lease modeling, look at, do we include, say, tenant improvements? How do we look in model market rents? Again, let's say we were looking at market rents. I might want to build it on, say, let's say it was in the UK, maybe just model the average rental of that asset class. So say office markets in London, I might want to use that as my index and say, well, our rents will grow at the same rate. But maybe if it's a very special building, maybe very high class, it might have a higher growth rate. And remember, in downtimes, especially if you're in the luxury sector, it might go down quicker as well. So remember, each building has different growth rates, what have you. We may want to look at cash flow modeling, and I'll discuss them more a little bit later on. But what generally steps we're going to be taking is building a pro forma. And the key word that you want to have in the back of your mind is, I need to be building a dynamic cash flow model. Okay, what do I mean by dynamic? Dynamic means that when we have our inputs on our Excel model, when we change them inputs, the model automatically updates itself. So for example, if my holding period goes from 5 years to 10 years, it'll build that cash flow model out for me and show me what my new return metrics are. The examiners or the test will never say build a dynamic cash flow model, build a dynamic model. You need to know that they are expecting you to build one, and you need to make it as dynamic as possible, because remember, when they're paying you large sums of money to work in real estate, they expect that the models to be very accurate and adjustable for their clients. Okay, so cash flow models, we talk about building this pro forma, making sure it's dynamic. We might be basing information in this pro forma on, say, current rental values, growth rates, operating expenses, what have you, maybe looking at cap rates based on comparables. And at the end result, once you build your cash flow model, you'll end up with a return. And so that might be the internal rate of return, a cap rate on that investment, what have you. So you need to have some good knowledge on what is cash flow modeling, what are the different components, how do we build a basic cash flow model. Another area is debt modeling, and there's a variety of different debt structures we can take in real estate. We could have, for example, interest-only financing, where every month we just pay interest on the debt, and therefore we should have high IRRs. Or we might look to do a constant amortization, where we're repaying a certain proportion of the debt every month. So our debt balance will reduce month on month, quarter on quarter. So depending on the type of debt that's being used, you'll end up with different returns and also different risks, because not only are we looking at how we model the debt, you want to know about the covenants on the debt that we're taking. So what is our loan to value ratio? What is our debt service coverage ratio? And if these terms are not in your vocabulary and you're thinking, what is Rob talking about? You might need to start looking them up now, okay? So that's just an insight there. You need to start building your knowledge on debt and making sure you have a good understanding of how does debt affect my cash flow, affect my lease modeling, and therefore affect my returns. And the final point there I've got is Argus data. And generally speaking, some companies use Argus data, some use Argus, but what you'll find is a lot of them are still using Excel, the majority, I would say. And what they may do is give you some data from Argus that you need to maybe upload into Excel, that you might need to analyze in Excel. So when you see this, don't be scared and think, I need to have a full understanding of Argus. They're going to probably train you on that if they want you to use that. They just want to see how do you extract that into Excel. Okay. So they're kind of the key areas that you're going to probably be tested on in some form or the other. You need to start building that knowledge on them. So they're the knowledge areas, but what are the scenarios that we often look at? Well, there's three. And like I said earlier, you need to look at what your company does that you've applied for. There's no point revising residential real estate models if you're applying to a firm that mainly invests in hotels. Okay. So if we're looking at acquisition modeling, generally speaking, you're going to be given a scenario where someone buys a building, is going to hold it for a certain period of time, may rent it, and then they're going to sell and exit that investment. Often holding periods with acquisition modeling are maybe 5 or 10 years long. Real estate development modeling, on the other hand, is slightly different. We're going to be buying some land. We're going to pay a certain amount of money for that. We're going to build, and therefore we need to often follow, say, a J curve. And you might have seen me discuss that in previous webinars. So you might want to build that building, and you might want to think about the gross internal area, what's the cost per square foot, what have you. And then they're going to probably stabilize that building, find tenants, rent it out. Excuse me, sorry, and then sell that building once it's complete, maybe after 5 years, 10 years after the building's complete. They may just sell the building without even renting it out. Another one is real estate renovation, and what you're going to see there is a bit different from acquisition. You're going to buy, maybe change the use, so maybe change it from commercial to residential, what have you, do some renovations on it, increase the returns on that building, and then sell afterwards. Remember, each one of these have very different debt structures, have very different cash flows, and the lease therefore change as well. So this is why these two interlink. The box you can see on the right here is the scenario that you're likely going to be given, and then you need to think about your knowledge areas and apply them to that scenario. Okay. So if you're doing often, say, development, you might be using probably interest-only financing and then going into repayment once you've got tenants and you've got a stabilized building. They may ask you about debt or equity perspectives. So you might be coming from someone who's a lender, say a bridging company or a bank that's financing this, and they may be thinking, well, what's my collateral? And you might actually be focusing on, say, the debt side. So what's the covenants in there? What's the likelihood that the profit's going to be there? And what's the exit yield? Is my cap rate that they're suggesting kind of sustainable and is likely to happen? More often than not, we're looking from an equity perspective, though. You're the one going to go and do this investment. And so that's what most companies are looking to do. But just be aware, sometimes they may ask you to do it from the debt perspective. Okay. Just a final note, these aren't all the scenarios that you may be given. There are some more new emerging kind of scenarios that are being given. The build to rent is now becoming more and more popular. That's a very different type of modeling than any of the above, really. Maybe akin to development modeling at the most, but build to rent is a new one, and again has kind of different cash flows and leases. A lot of policy risk with build to rent at the moment. And there's a couple of others that maybe don't fit this mold, but the majority that you'll be given will be on these three areas. Now, what I've done there's a big list here of assumptions, and this is actually some questions. So this was actually some data that was from a financial modeling test, and this was given to people to model. So this isn't just me making up some random bullet points here. This is actually real world kind of bullet points that a recruiter give to someone to do. And this is what they had to the model they would have to build from. So you can see they give you a large number of modeling assumptions. We're giving maybe some other assumptions that I'll talk about a little bit later on, and maybe some return metrics that might be the target rate of return that investor is looking for, equity multiples and profit shares. And often we have these waterfall distributions when there's many investors involved for these type of buildings. So if we start on the left and look at some of the modeling assumptions, we can see that we're given information such as acquisition dates. So that would you will build from there if you're developing the building. Well, when will construction start? There's going to be a lagged phase to that. Notice on the interest, that'll have an impact there too. We're given information like the purchase price and any acquisition costs. A very standard cost I would expect to see is 6.8%, following red book guidelines there. You got your net internal area and gross internal area of the building. They may provide a glossy brochure as well, where you might have to extract that information from and put them into the assumptions. Now, remember, with your internal areas and gross, that's going to affect your rent, right? It's your rent per square foot or rent per square meter. So you can use that information to calculate what your income is going to be. In this case, we can see 20,000 square foot is actually non-usable. Quite a large proportion of that building we would call as maybe maintenance or non-usable space. So the question I would be asking is, why is it so large? Can we increase that? That will increase the returns, of course. We are told that it's a freehold, but if it's a leasehold, you're going to have to put that into your operating expenses. We're told information about the cap rates. That'll influence what our sales price will be. So the exit yield, 4.75%. So where would we use that? Remember, you'd be taking your final income in the final period divided by that exit yield will give you your sales price there. Again, we've got the next person's purchaser's cost that we might want to take into account of how much we might want to include that in that sales price. And therefore we need to discount that out. So the way we do that is take our sales price divided by 1.068, and that will back out that 6.8% costs. We might want to look at any disposal fees that we may have. We're given information on the holding period. So we've got a 5-year holding period. How does that affect with our lease? That's what that type of information is going to make me think. We're giving some debt information here. We've got financing at 50% loan to cost. We've got a high interest margin, 3% above the regular lending rate. So roughly speaking, you're looking at about maybe 10% in today's market to finance this deal. We've told that it's interest only. So I mentioned that before for 51 months. Then we go into a long-term 30-year amortization debt. And then we've got some business plans, what have you. Now, this isn't an exhaustive list of kind of assumptions that they may give you. I've put some others at the side here. We might be given agent fees of how much they're going to charge us when we rent the building out. There might be other development costs like utility bills, what have you, maybe building a road. That will also have an impact. There might be tax or VAT implications that you might need to control for. Now, the other thing that we should note when we do these tests, they give us some assumptions. We also need to make assumptions. And one way to do well on these modeling tests is to make sure that your assumptions are extremely clear to the examiner. They want to be able to see that you can think like a real estate analyst and that you can think, oh, right, that's not included. I need to assume that. If my growth rates in rents are 3%, is that realistic? Maybe they should be higher, with current growth rates in rents being about 12% in a lot of cities at the moment. So maybe we assume these things. And often what I find is students fail to assume. They say, I've not been given that information, so I'm not going to even attempt, to assume anything. That's the worst thing you can actually do. You need to make your assumptions very clear, and that will show the examiner or the person reviewing your work kind of what your thought process is. They're reviewing how you think. Will you fit into this company well? Okay, so make your assumptions clear and it should be good. In the bottom here, we can see some of the return information, and we'll see return information later on how we will present some of our return information. So on the next slide here, what I've got is an example of some of the information that you might need to create. This is kind of an example, and I know some of this is quite small, so I'm going to zoom in slightly so you can see. Now, I want you to take note of this, that this is actually some work that people have done in the past that I've actually received. So I'm not saying this is the best way of presenting, right? And we can pick up on some of the problems when we look at this person's attempt on a question. I've kind of hid some of the personal information about the building because it's actually a real life building, this. So this is an idea of what this person created. Well, we can see that they've got a variety of summary information that the reviewer can look at the beginning. We've got, for example, what the rents are going to be. We've got information about the holding period here in the top left, any expenses that we may have, investment horizons, what have you. You might want to talk about the valuation method come to use. Is it a DCF, term and reversion, hardcore and layer? Depending on which one you use, you might want to tell the reviewer that. We've got an acquisition price, costs, what have you, and you can see that the all-in cost they've noted and highlighted. One of the things that people fail to do often is make the formatting very clear here. So you really need to take some time to make sure that it's very obvious what you're presenting to the reviewer. We've got the financing assumptions, therefore showing the reviewer that debt's been included. We've got, now because this is actually, this building has 3 different types. It's got residential, retail and office space. We have a variety of information in this one. So we've got cap rates for both residential, retail and office. Now, if you've assumed any of them, I'd be making some notes and telling the reviewer why you've assumed a lower cap rate for residential compared to retail. That's the type of thing that shows that you've thought about it and you understand what you're doing. We've got growth rates. Notice they've assumed a similar growth rate across the holding period for residential and retail, slightly lower for office. Is that realistic based on CPI growth rate of 3%? If it isn't, you need to upward adjust them. Any allowances for bad debt, what have you. So what this area is showing me is all the assumptions that a reviewer needs to know. And some issues with this is it doesn't have, for example, is the CPI the best growth rate for rents? Probably not. I'd probably be using another index, maybe based on what some of the REITs are basing theirs on. So I think there's better kind of growth rates that we can use. It's not very clear what, is that interest rate, what is that interest rate for? Is it all the same? Remember, residential interest rates are very different to commercial. Ooh. So if we zoom out, so once you provide your summary information, you next go on to your cash flow model here. So remember, you'll be building your pro forma statement, and then you'll be going into modeling your lease events, how much income you're going to be earning. So at the top here, often we'll have our quarter dates. One of the assumptions that most people do is we often teach real estate modeling with quarterly cash flows. Often, especially the American real estate modeling tests are actually monthly cash flows. So just take a note of that. If they don't tell you, I'd probably be modeling it on a monthly basis, not quarterly. But let's just assume they've asked us to do it quarterly. So we've got our quarter numbers here, we've got the months, and we can see the holding period. Now, one of the things that I can see is that, say I was reviewing this, is they've said that their occupancy within one quarter goes from 0% to 100. Is that realistic? Do you get 100% occupancy? How many units were you renting out? Maybe it would actually only be 50%. They've also assumed here, if we look at, say, some of the occupancy figures, I'm not seeing much on vacancy. I'd probably expect a row there to describe, well, what's the vacancy rate? Remember, it's just 1 minus the occupancy rate. But again, shows that you've thought about that. We're seeing that they've got controls here for rent-free periods, the operating costs, and we can see our rental income here. Purchase prices here and sales price over there. Remember, these should all link with the inputs that I've just shown you in the summary information. So if the purchase price changes, that should, if it's a dynamic model, automatically update into your cash flow model. Presentation is okay on this one, could be slightly better. Now, to really excel when you're doing these tests, I'd look at sensitivity testing. So we build sensitivity tests. Now, if we look at this table, one of the issues is it's not very clear to a reader what are they actually testing. What is the information in here? It looks very pretty. What they're showing is actually the lagged internal rate of return, not actually something we normally do. So I actually wouldn't present that. However, the kind of the look of this sensitivity table, I think, is something worth doing. We can see we've got axes on the exit yield. As the exit yield goes higher, how is that affecting across our holding period? These type of tables are really good to show. And remember, with the dynamic model, this will automatically update based on the information that you have. So if you have a 5-year holding period, you need one of these for 60 months. The final bit, which I wouldn't expect too many people to be able to do, depending on how much you really want the job, you could then start to do simulations. This could be Monte Carlo simulation, is common in real estate. And when you do simulations, again, note an issue with this graph. What is this y-axis? They're the small things that as a reviewer, I'd be picking up on. What is the x-axis? I can tell it's holding period, but it's not actually said that, right? So if you want to do simulations, you can do. My main concern, if I was you, is getting the summary information right, cash flow model and sensitivity tests. If you're able to do Monte Carlo simulations, that's really good, but the majority of people wouldn't. I'm showing you how to get to the best tier there, depending on what job you want to go into. I'm aware I'm quite over time here, so I'm just going to spend a little bit of time just on some final tips and tricks to prepare for your test. The knowledge of the models is key. Is it waterfall structures? What type of development are you doing? Is it kind of refurbishment? Is it development? Is it acquisition? What have you? Knowing how they work and the debt structures used within each, remember they always change, will affect your end outputs and will affect your cash flow model and sensitivity tests. One thing that you need to learn to do is not waste time on spending too much time on building graphs. You need to be really quick at building graphs. You need to be able to add them X and Y axes, make it really clear to a reader. Investors love graphs. It shows a lot of information very quickly. Learn how to do that very quickly. Practicing building tenancy schedules and pro formas and cash flow models will probably take the longest amount of time to do. It's very difficult the first few times, and over time you'll begin to understand how the if function works, or function, what have you, when you've made mistakes with your MPV, what have you. So just take your time learning them. How do they all link in together, making sure that they're dynamic and you've not hard coded, is really key to creating a good model that will get you into that job. A lot of students in the stress of the time will forget that return metrics are time weighted and you need to discount them back to today's money. Because people spend so much time on their cash flow model, making sure it looks good, they often forget the simplest things, such as discounting them final cash flows back in time. Remember, they're time weighted. And final thing there in terms of how to prepare, sense check your calculations. If you have an IRR of 39%, I probably think it's wrong. It's not realistic. Making sure you sense check everything is really important. I say it to everyone that goes into one of these tests, and please just do it. It takes 2 minutes to sense check. And if you do that, if you've got very high results, you might want to just check them out because they're the big things. Because if you go to an investor, oh, you're going to get a 40% rate of return, your company's not going to be very happy if that's really incorrect. 5 reasons why people often fail the test or don't progress. You don't really fail it, you just won't progress to job offer. They fail to build in them dynamic models, so the hard code data. That's one of the main reasons. Maybe you could incorporate switches. That would be good to change your, say, debt modeling. The assumptions that you put in are not clear. They're not explained. If I don't know what you've put in, say you put an interest rate of 5%, well, why is it 5% when, the current rates are 5.75? Maybe you think rates are going to go down. Then it's fine to assume 5%, but you need to make sure it's clear why you've done that. Sometimes people, although they understand the basic Excel functions, they don't understand how to apply them properly. And therefore they spend so much time trying to apply a simple function that they're not spending enough time working on the actual project. Formatting is really key. Making it look presentable is really important. Companies want to look professional because they're selling this advice to their client. So leaving formatting till the end will often mean that you're going to run out of time. And the final thing that I'd like to mention is stress. These kind of real estate modeling tests are not written by academics like myself. If you do one of my exams, I have thought about how long it will take you to do the exam, and the exam will take you 2 hours, say, or 3 hours, and probably some buffer time. These modeling tests are written by professionals, which is okay, but they're there to make you stressed. There's way too much work to do in one kind of modeling test. They're there to see how you're stretched, to see how you will adapt, and how you'll fit into a company that will probably have quite a high workload. So don't expect to get everything right. There's probably no right answer to the modeling test that you're doing. Just make sure that you try your best, take your time, make sure everything's clear and neatly presented. To me, that would say, well, you need to join this firm because you're fitting in with what we do. Okay.